First of all, thank you for having me. It's great to be here. I do think that the markets are trying to time something which is very difficult to time because the data itself is fluctuating, as you say. The central banks are going to see a certain level of data and a consistency of data before they act because they've, after all, gone through a year and a half to two of rate rises more, and it's not going to turn on a dime. The economy doesn't turn on a dime. Even the UK, we saw a small inflation surprise yesterday. So I think we've got to wait a little.
Is that the problem, though? The waiting means that you could be too late to react if you're a central banker. I mean, from the UK lens, for instance, we are setting up the three experts saying, look, we'll be back below 2% on inflation in about 4 or 5 months. So in touching distance for inflation, if central bankers wait for the evidence before their very eyes, they're going to be too late to cut, aren't they?
Yes, but we're dealing with a period of volatility, not just in underlying economic data, but, think back over the debates we've had over the last 2-3 years. Is inflation persistent? Is it not? Do we have a supply shock? Do we not? Are we going to get a soft landing? Seems like we are. Are we not? And then there are geopolitical events. So I think in this environment, you may be a little late, you may be a little early, but frankly, trying to time it precisely, whether you're an investor, whether you're a central banker, whether you're a regular banker, I think is very, very hard.
It's very interesting you refer to yourself as a regular banker. OK, well, we'll go with that. As a regular banker, settle another argument for Karen and I, which we've been having for years. When interest rates are at the level they are now, compared with the recent history, is it great because of the increased net interest margin and net interest income, or is it bad because you have a rise in delinquency, or is it a lot more subtle than that and it's a bit of both?
It's a bit of both. The almost miraculous thing that we have seen in this last 2 to 3 years of the inflation rise and then the softening is we've seen it without a credit problem, really at a corporate level or at an individual level. Now, it's partly because of the COVID stimulus in the economies. It's partly because employment has remained high in the developed world, and as long as people have jobs, they manage their finances. We see that in our consumer businesses. So it's a very, very unusual one, and I think we should take it.
What shape do you think the UK consumer is in? Because this time feels a little bit different. Pent-up savings, strong labour market, still a lot of animal spirits. Do you think the UK consumer is in good shape in 2024?
I think the UK consumer is in very decent shape. The spent-up savings have been getting eroded. On the other hand, it's a floating rate mortgage market, and a lot of the mortgage adjustment has happened because the average term is about 3 years fixed, and we've had 3 years of rising rates. Energy prices have calmed down. So the two things that hit the pocketbook are calming down. And I will say that I'm very optimistic on the UK. I think that, growth is not great, but growth is fine. It's not as strong as the United States, but, there's so many institutional advantages in the UK. And it's the home, as you know, of so much innovation, so much technology. And most importantly, we spoke earlier that you had the Shadow Chancellor of the Exchequer here. I think political risk in the UK is far less than it's ever been. This election, whenever it comes, is not Margaret Thatcher with James Callaghan. The difference in economic policies between the two, and they're both striving to say so,
You're so
are fairly
right.
minimal.
I remember being a FTSE option trader, and I think it was the early 90s when there was an election. It was like, if it's Labour, we're down 400. If it's the Tories, we're up 200. But it's not like that. I agree with you. There's not a lot between Hunt and Reeves at the moment in terms of what I can see. Venkat, as a regular banker, at a very regular bank, I've got to ask you the questions. All I'm getting is a drip feed of information. I don't know how much of it's coming from within Barclays, but there's a lot of information about your strategic review, about the transformation, which I think is a stunningly tough job for you. I make no bones about it, but you paid a lot of money to do it, so I'm not worried about it. I know you're only going to give us the full details in February, but what can you tell us about how the strategic review is going and when we're going to get some real news on it?
Well, the review is going to be presented along with our earnings on the 20th of February, so it's not that far away. We are trying to address 3 basic issues. The bank has not done a review in 10 years, and we last presented our financial targets in 2016. So first of all, we've increased our ROTE, the return we produce, from single digits to double digits over the last number of years, 5 to 7 years, and we've been double digits for the last 3 years. The second thing is that, so we've got to be talking about what our return targets are. Then we've got to be clear about how much of these returns we are going to give to shareholders, and what business footprint and what business progress we're going to make that enables both of these things. That's really what it's about in a nutshell.
What are the options around M&A? Because we're going into a very interesting environment. We tackled NIMs a moment ago, but the reality is those NIMs are not going to get better from here because of the interest rate cycle, which puts pressure on the fee side of the business. Well, exactly. So wealth or asset management sectors seen as key to consolidate. Are you a consolidator over the next 12 months?
So the focus of our plan is really to do things ourselves. You know, bank M&A is a very, very difficult thing to do. It's opportunistic. And you can't assume it in a normal business environment. So I think what you're going to see is us pulling ourselves up by our own socks, pulling our socks up and tying our own shoelaces.